Macro conditions for stocks to continue their bull run remain in place, but we wish to warn that risks are building. In the US, manufacturing continues its resurgence, while new orders for durables on most measures has put in 2 strong months of positive revisions to back data. While we expect services to sustain the recovery, manufacturing is enjoying a second wind from overseas demand. We expect this to continue to translate into jobs and consumption for the year. In China, industrial production, retail sales all posted reasonable on-year expansion, while investment grew phenomenally due to the government's drive to provide low-cost housing. This factor alone is a strong mitigator against a hard landing scenario as the central bank continues aggressive tightening. We don't expect many reserve ratio adjustments left as money growth is back to normal, but we do expect at least 3 more rate hikes. Singapore itself sees a high level of activity as industrial production posted handsome expansion for the first quarter of the year, and tourist arrivals continue their uptrend. Singapore may also have begun a new cycle of investment demand as we believe investment GDP ratios have bottomed out. We expect Singapore banks to benefit from this, and DBS remains our top pick. On the earnings front, 75% of S&P 500 companies have beaten earnings expectations, whilst in Singapore, DBS, CapitaLand, Capital Malls Trust, Capital Corp, Jardine Cycle & Carriage have beaten expectations, while Capital Malls Asia's results were mixed but forward-looking. Expectations for the year are still within reason to achieve our forecast that the STI would reach 3,650 by fourth quarter 11. The key risk to this thesis is now inflation surprising on the upside, yet central banks being behind the curve and raising interest rates. Specifically, the US is now starting to look slow as the economy improves, yet the Fed remains divided on the issue. A too-easy policy is beginning to fuel too fast a commodity price inflation, which ironically will begin to hurt Asian economies, which are helping the US manufacturing export boom. That said, overall, yield curves, output levels, consumption data, and earnings are so far still pointing towards a positive market. We will continue to monitor the situation. Thank you.